the weakness there being talked about in the US economy came through in the ISM, conflicted by or contrasted with the PMI data, maybe a bit more positive. Maybe there's a Boeing effect in there. But you must see a weak picture for the US economy to be predicting that the Fed is going to have to cut 3 times this year. What's your backstory?
Yeah, and one of the things we don't do is to pay any attention to the strength of the consumer. Our assumption and, well, our thesis is
in an economy with such a large proportion of the economy driven by the US consumer.
Yeah. Outside of recessions, the US consumer is extremely strong. We don't need to analyse it. It's certainly not a leading indicator in our view. So looking at where the dollar is trading is far more important than where the level of consumption, in our view. What's more important is looking at some of the tail risks that there are in the economy to see whether those tails are getting any fatter. One of those, which it's not going to cause the next crisis, but you look at auto loans and you look at the rate of delinquency on those loans. Now, it's not a big driver. It's nowhere near as significant as mortgage defaults, but this is a sign that the consumer, they may be happy to spend, they're happy to borrow, but their ability to repay is deteriorating somewhat. But I'm much more interested actually in how much liquidity is the Fed putting in, what is their monetary policy relative to what it needs to be to continue to keep this economy going. And it needs to be much lower. Our estimate of the Fed's neutral rate is still much lower than current monetary policy. So we think that the economy is still being burdened by over-tight monetary policy.
And you think the Fed's going to cut a lot this year?
Yes. So the way we'd expect this to play out is that the Fed, this pause that they're communicating to the market, it will last for about a quarter. Then we would expect by then that we've seen a significant downdraft in equities. They've continued to add in liquidity, but I think they'll have to acknowledge that they'll need to cut the rate further. Primarily, it's to get the dollar lower. The dollar is one of the main problems that the US economy suffers from. When we're looking at our models, what does the Fed need to do to allow this expansion to continue? They really need to get the dollar lower. If they fail to do that, then they need to be stimulating credit by getting rates a lot lower than this. So this is why we forecast 3 rate cuts this year, and we do this thinking that the Fed will start on this path in reaction to having a much weaker economy.